Loan portfolio diversification can help to protect a bank in an uncertain economy because certain industries and even areas are going to be hit harder than others during economic uncertainty. And so by spreading that risk across different regions, industries, and loan types, your bank's going to be able to reduce the risk of experiencing widespread defaults. And so for the community banks that are looking to enhance the performance of their long-term portfolio, they can leverage trusted partners to be able to gain access to the top-tier borrowers that are just outside of their local markets. So when banks are looking at diversification in terms of sector, loan type, or geography, they should be focusing on avoiding overconcentration because, as we know, certain industries are going to be more sensitive to the economy or regulatory changes. Certain regions might experience weather-related risks. They might have different policy changes or just vastly different economic conditions. And even consumer and commercial loans, they might react differently to changing markets. And so I don't think that a strong portfolio is going to have a bigger emphasis on industry over region over loan type. It's about having a healthy balance between all three. Some best practices for building a diverse loan portfolio, we're going to start with setting intentional diversification goals because you want your organization to be aware of how much exposure it wants in each industry, each region, as well as each loan type, and whether or not those goals are going to align with your company's overall risk tolerance and growth strategy. Next would be to keep your standards high, right? Diversification should not come at the cost of credit quality. And so banks can leverage trusted partners that are outside of their local markets to be able to gain access to the top tier borrowers that are going to allow them to build a more profitable, more stable, and resilient portfolio. When the market's volatile, the board's role becomes even more important. And so they should be asking questions like, are we running stress tests regularly? Do we have the systems in place to be able to catch the early warning signs of risk? And if that borrower risk starts to rise, how quickly can we act? It's also about ensuring that the information that you're looking at in terms of credit reports are up to date and they're not already lagging behind. Provisioning needs to stay flexible in an uncertain economy because you want to be able to make adjustments in real time while looking out for signs of rising unemployment, shifts in spending, and changes in borrower behavior, and not overlooking risks like unused credit lines. But finding the right balance is key because a balanced reserve strategy is going to support ongoing lending while keeping the bank's financial health intact. But if you're too conservative, you limit the growth. And if you're too aggressive, then you overexpose yourself and become vulnerable to potential unexpected losses. And so if banks can stay adaptable, then I think that they should be able to stay ahead of potential losses instead of reacting to them too late.